Trend reversal patterns help traders anticipate turning points in the market. Spotting them early gives you the chance to close your current position at a profit, or enter a new position right before momentum shifts, maximizing reward while minimizing risk. In this video, we are going to talk about what trend reversal patterns are. We'll explore the different types of reversal patterns, how to confirm them using breakout and candlestick signals, and walk through real chart examples to see them in action. Finally, we'll discuss common mistakes traders often make with these patterns and how to avoid them for better trading decisions. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. Trend reversal patterns are powerful chart formations that signal a potential change in the direction of the current trend. These patterns typically appear after a sustained move, either upward or downward, and indicate that buyers or sellers are losing control, making way for a possible market reversal. Let's start with one of the most reliable reversal patterns, the head and shoulders. This is a bearish reversal pattern that consists of three peaks. The left and right peaks are known as the shoulders, while the middle and highest peak is called the head. Beneath the pattern, there's a neckline, which acts as a key support level connecting the two lows between the peaks. The pattern is confirmed when the price breaks below the neckline with strong momentum, signaling the likely end of the uptrend and the beginning of a potential downtrend. On the other side, we have the inverse head and shoulders, which is a bullish reversal pattern. This pattern consists of three troughs. The two outer troughs are the shoulders, and the deeper middle troughs forms the head. The neckline in this case is a resistance level connecting the highs between the troughs. Confirmation occurs when the price breaks above the neckline, indicating that buyers are regaining strength. When this pattern appears at the bottom of a downtrend, it often signals a shift toward bullish momentum, an opportunity for potential long entries. Moving on to the rising wedge, a bearish reversal pattern. In this setup, price action forms higher highs and higher lows, but within a narrowing upward sloping range, reflecting weakening bullish momentum. The pattern is confirmed when the price breaks below the lower trend line. When a rising wedge forms during an uptrend, it signals a potential reversal to the downside, often providing a high probability sell opportunity. Conversely, the falling wedge is a bullish reversal pattern, where the price forms lower highs and lower lows within a narrowing downward range. This tightening movement suggests that bearish momentum is weakening. The pattern confirms once the price breaks above the upper trend line. When a falling wedge appears at the end of a downtrend, it signals a potential reversal to the upside and often presents a strong buying opportunity. Our next pattern is the double top, another common bearish reversal pattern. This formation includes two peaks formed at approximately the same price level, with a support line, known as the neckline, located below them. Occasionally, a third peak may develop, transforming the pattern into a triple top. The pattern is confirmed once the price breaks below the support line, signaling a loss of upward momentum and a potential shift into a downtrend. Conversely, the double bottom is a bullish reversal pattern. It consists of two troughs formed at nearly the same price level, with a resistance line positioned above them. Sometimes, a third trough forms, creating a triple bottom. The pattern is confirmed when the price breaks above the resistance line, indicating that sellers are weakening and buyers are stepping in. When this setup forms at the bottom of a downtrend, it suggests a potential upward reversal and a possible buying opportunity. Confirming a trend reversal pattern is critical before taking any trade. To confirm a reversal pattern, the most important signal is a strong candle close beyond the pattern's key level or neckline. The breakout should be supported by increased volume, which indicates strong participation and commitment by market participants. Decreasing volume and consolidation in the middle of the pattern. Look for confluence factors such as support and resistance zones, or alignment with higher time frames. Avoid entering trades prematurely, as this increases the reliability of the pattern and improves your risk-to-reward ratio. Once a trend reversal pattern is confirmed, having a precise entry and exit strategy is essential for managing trades effectively. After the breakout, wait for the price to pull back and retest the breakout level. If that retest is followed by a candlestick confirmation, it provides a more conservative and higher confidence entry point. Place your stop loss just outside the structure of the pattern. For take profit, measure the height of the pattern, then project that same distance from the close of confirmation candle. This method can be used for all the reversal patterns to set your take profit. Let's now take a look at how these trend reversal patterns play out on real charts. Here, the market is clearly in a downtrend, creating a series of lower lows. An inverse head and shoulders pattern formed at the bottom, a key signal of potential reversal. The neckline is broken with strong bullish momentum, confirming the pattern. But instead of entering immediately, we wait for a retest of the neckline. At the retest point, a bullish candlestick pattern forms, giving us a high probability entry. The market respects the neckline and reverses upward, confirming the strength of the setup. In this example, the market is again in a downtrend, but soon forms a double bottom, a W-shaped pattern indicating that sellers are losing momentum. The two troughs are nearly equal, showing strong buying interest at that level. The pattern is confirmed when price breaks above the neckline. We wait for a pullback to the breakout level rather than jumping in immediately. On the retest of the neckline, price forms a bullish confirmation candle. This provides a clean entry point, and the market resumes its upward move, completing the reversal. In the next example, the market is in a clear uptrend but begins to struggle at the top, forming a triple top. The three-peak signal repeated failure to break higher, showing growing bearish pressure. Eventually, price breaks below the support line, confirming the pattern. We look for a retest of the support level, which now acts as resistance. On the retest, a bearish candlestick pattern appears, giving us confirmation. This marks the start of a trend reversal from bullish to bearish, and the price begins to drop from there. While trend reversal patterns can be powerful tools, many traders fall into common traps that reduce their effectiveness. One of the biggest mistakes is entering too early, before the pattern is fully formed or confirmed. This often leads to false breakouts and unnecessary losses. Another common error is ignoring volume, which plays a key role in validating the breakout. Weak volume can signal a lack of conviction and potential failure of the pattern. Traders also tend to force patterns where none exist, misinterpreting normal price fluctuations as pattern formations. It's equally important not to rely on a single pattern in isolation. Always look for confluence with support and resistance levels, candlestick signals, or higher time frame trends. Lastly, poor risk management, such as oversized positions or neglecting stop-loss placement, can turn a good setup into a costly trade. Avoiding these mistakes can greatly improve your consistency and confidence in trading reversal patterns. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.